Hi, welcome back to my lesson. This is chapter 7, part 5. So in this chapter, we're going to talk about two topics. What's going to happen when the policy holder dies? What are the tax consequences? Or when the policy is assigned to someone else? So absolute assignment is when the policy holder transfers the entire policy to someone else. And for the sake of the exam, we have to differentiate between the spouse, the policy's children, grandchildren, and a non-arm's length person, which is like, a person other than the policyholder's children and spouse. There's no tax consequences when the policy is assigned to a spouse. Okay, however, you got to pay attention to the ACB. Basically, the spouse that receives the policy will inherit the original ACB, adjusted cost basis, not the cash surrender value, not the current cash surrender value of the policy. So in this example, Noah assigned the policy to his wife. So the original ACB of the policy is $32,000, but the policy currently has a value of $85,000. When the wife inherits the policy, she also inherits the ACB of $32,000. So in the future, when she surrenders a policy, then the original ACB of $32,000 will be used for calculating the policy gain, not $85,000. The policyholder can also assign to his children. His child, the definition of child is actually very broad. Basically, it includes the policyholder's child, great child, or great grandchild. Now, unlike the spouse, transferring to a spouse, there are some conditions for transferring the policy to a child without incurring any tax implications. Number one, the child cannot pay anything, make any payments to the policyholder for taking over the policy. Number two, the life insurer of the policy must be the child themselves. And just like the case for transferring the policy to the spouse, if both of the criteria are satisfied, then there'll be no taxable policy gains. And just like the spouse, the child will inherit the original ACB. Now, if the policy is transferred to someone other than the children or the spouse, then it is considered as a full surrender. So in which case, we have to calculate the policy gain, which is the current cash surrender value minus the ACB, and is 100% taxable. So what if the life insured and the policyholder are two different persons and the policyholder has died? So in this case, obviously the death benefit will not be paid because the life insurer is still living. However, from a tax perspective, this is treated as a deemed disposition unless certain things happen. Like, for example, the first one is the deceased policyholder had a spouse. So automatically, the policy will be rolled over to the spouse, just like transferring to the spouse, there will be no policy gain, no tax consequences. Or if the policyholder has children, then the policy can also be rolled over to that child when the policyholder dies. However, unlike the spouse, this is not automatic. Before the death of the policyholder, he must have put the child on the policy as a contingent policyholder. So when the policyholder dies, then the child will automatically take over the policy, and there will be no taxable policy gain. If this wasn't done, then unfortunately the policy will go into his or her estate, and there will be like deemed disposition too. All right, so what if the policyholder before his death named someone other than his child as the contingent policyholder? All right, let's have a look. Number one, the policy will still bypass the estate, which is good. There'll be no probate tax. However, the deceased policyholder would not be able to avoid the deemed disposition because this contingent policyholder is not his child or his spouse. So the policy will be fully taxable. And that's the end of this short lesson.